Hello and welcome back to Money Never Sleeps. My name is Timur from M&A Wealth. If you'd like more information about what you hear during the show, give us a call at 866-973-3627 or visit us online at mnawealth.com. And while at my website, click on the page to check out past shows and subscribe on Apple Podcasts or Spotify. During today's episode, we're going to highlight common 401k mistakes that could make it harder to reach your retirement goals. A Kiplinger article, 8 401k Mistakes That Could Tank Your Retirement, has some eye-opening details. The first mistake to avoid is simply not understanding the difference between 401k plans. When it comes to 401k plans, you might have two options, a traditional 401k and a Roth 401k. But do you know the difference between them? Let's break it down. First, what they have in common. Both traditional and Roth 401ks allow your contributions and any investment gains to grow tax-free. They also have the same contribution limits, and if your employer offers matching contributions, both types of accounts qualify. Now, where they differ. A traditional 401k is funded with pre-tax dollars, meaning you won't pay taxes on your contributions now, but you will when you withdraw the money in retirement. This upfront tax break can be a big advantage, especially if you are in a higher tax bracket. A Roth 401k, on the other hand, is funded with money you've already paid taxes on. The upside? When you retire, you can withdraw your contributions and any earnings completely tax-free as long as they are qualified distributions. The next common mistake is not doing your due diligence when changing jobs. Switching jobs can mean a nice bump in salary, but are you making the most of it? According to the 2024 Vanguard study I referenced at the top of the show, 55% of job switchers ended up reducing their 401k savings by $300,000 during their lifetime, simply because they didn't adjust their savings rate to match their new, higher income. The study notes that most employees, 64%, saw about a 10% pay increase when they changed jobs. But here's the kicker. Fewer than half took the smart step of increasing or even maintaining their previous savings rate. Instead, most people unintentionally decreased how much they were saving for retirement. The study also found that those with voluntary 401k enrollment fared even worse compared to those automatically enrolled. But even auto-enrolled employees weren't in the clear. 60% stuck with the default savings rate, often just 3%, which usually isn't enough to build a strong retirement fund. It's easy to overlook increasing your 401k contributions when you get a raise. But if you don't, you risk underfunding the lifestyle you're used to just when you'll need it most, in retirement. The next mistake to avoid is forgotten 401ks. Here's something you might not know. Your 401k doesn't just follow you when you switch jobs. And that might explain why, as of May 2023, there were a staggering 29 million forgotten 401k accounts out there, holding more than $1.6 trillion in unclaimed money. Yep, that's trillion with a T, according to the latest data from Capitalize, cited in the article. It's easy to see how it happens. You land a job, set up a 401k, then move on to something new, and boom, your old retirement account slips off your radar. The good news? If you've got a lost 401k, there's a way to track it down. Thanks to the Secure 2.0 Act of 2022, the Department of Labor is working on a retirement savings lost and found database to help people reconnect with their old accounts. It's still a work in progress, but definitely worth checking out if you think you might have some retirement money waiting for you. To find out more about that program, visit lostandfound.dol.gov. Moving on, the article next touts not knowing or understanding your current 401k investments as an error you should work to avoid. If you've just set up your 401k and forgotten about it, you're not alone. A lot of people, especially those automatically enrolled, don't pay much attention to how their money is actually being invested. But here's the thing, it's worth checking on. Many financial services professionals recommend adjusting your risk level over time, going for more growth when you're younger and shifting toward less risk as you get older. One way to do this without much effort is with target date funds. These automatically adjust your risk level as you age. Fees are another reason to keep an eye on your 401k. High fees eat away at your savings, leaving less money to grow over time. At the very least, take a look at your 401k's annual fee disclosure statement. But even better, log into your account every now and then to check on your investments and fees. A financial services professional can help you make sense of it all. And if the fees seem high, one option to consider is to contribute just enough to get your employer match. That's free money. And then put the rest in an IRA, which also comes with possible tax benefits. The article's next common error is not taking full advantage of your employer match if your company offers one. This is a simple way to boost your retirement savings without doing any extra work. Many employers offer a 401k match, meaning they'll match a portion of what you contribute, usually up to a fixed percentage of your salary. And here's the kicker. If you're not contributing enough to get that full match, you're basically walking away from free money. It's one of the easiest ways to grow your retirement savings, so if you're not already taking advantage of it, now's a great time to start. Not being vested is another 401k mistake to avoid. An employer 401k match is a great perk, but there's a catch. You might not get to keep that money right away. That's because of vesting, which means you must work for your employer for a certain amount of time before those matched funds are officially yours. A common vesting schedule runs 3 to 5 years, but every company is different. Some let you keep a percentage of the match each year until you're fully vested, while others require you to stay the full period before you get anything. The good news? The money you contribute is always 100% yours no matter when you leave. So before you plan your next career move, check your company's vesting rules. You don't want to miss out on money you've been working toward. Early withdrawals are another common error. If you're thinking about dipping into your 401k early, think twice. While it might seem like an easy solution when money is tight, things like cashing out, taking a loan, or making a hardship withdrawal can seriously derail your retirement savings. That said, life happens. And if you're facing a real emergency, using your 401k might be unavoidable. The upside is that 401k loans often come with lower interest rates than traditional loans. And since you're borrowing from yourself, repayments happen through payroll deductions, plus they don't affect your credit score. But here's the downside. If you cash out before age 59 and a half, you'll likely get hit with a 10% penalty plus income taxes. Even hardship withdrawals, while available in many plans, often come with extra fees. Taking money out too soon is one of the big reasons so many people struggle to save enough for retirement. Bottom line, if you can avoid it, leave your 401k alone. Your future self will thank you. If you have any questions about your retirement magic number, your retirement strategy, or any other parts of your financial strategy, visit my website at mnawealth.com or call my office at 866-973-3627 to discuss how my team might be able to answer your questions and address your concerns. It's our goal to help you prepare for the retirement you've worked so hard for.
Disclosure. All matters discussed during the show are for informational purposes only. Opinions expressed are solely those of M&A Wealth and staff. All topics covered are believed to be from reliable sources. However, M&A Wealth makes no representations as to its accuracy or completeness. This commercial shall in no way be construed as a solicitation to sell securities or advisory services to residents where permitted. Topics should be discussed with your individual advisor prior to implementation. Advisory services offered through M&A Wealth, a registered investment advisor in the state of Texas. Insurance products and services are offered through PNC Life Insurance Agency, an affiliated company. M&A Wealth and PNC Life Insurance Agency are not affiliated with or endorsed by the Social Security Administration or any government agency.